Awesome. Welcome, everyone, and thank you for coming to our session on really the institutionalization of digital assets. I think we're going to try as best as possible to really look into seeing what is happening in the digital asset space from an institutionalization perspective, where the roles of these different players on this stage sit, and where we think the market is going as a whole. Before we start, maybe I'll have everyone quickly introduce themselves and what their companies are doing, and we'll then jump right into it.
Thank you, Stephen, and thank you to the TOKEN2049 organizers for the opportunity. I'm Giovanni Vicioso, Executive Director and Global Head of Cryptocurrency Products at CME Group. For those of you unfamiliar with CME Group, we are the world's leading derivatives exchange. We offer futures and options on futures across 7 different asset classes, including cryptocurrencies. Looking at cryptocurrencies, we have futures and options on both Bitcoin and Ether, and really happy to be part of the conversation today.
Thank you, Stephen. Thank you, organizers, for having me. Prady, most people here would be familiar with Temasek. Within Temasek, I lead our blockchain effort. It has 3 components. We do the usual direct investing, more at the mature stage. We do fund investing. That's our way of supporting the early stage crypto and non-crypto blockchain ecosystem. And then what we also do is in white spaces, we build our own startups.
Awesome. Evgeny?
Yeah, hi everyone. My name is Evgeny, CEO of Wintermute. Wintermute has been around the space for about 6 years. We are very active across 3 main verticals. It's centralized exchange trading, DeFi, and OTC. And overall, it's really great to be here. It's not the first time, it's not the last time.
Hi, Rhine. I'm at Galaxy Digital. I work in the asset management group. We have exposure across venture, passive, and active. I run our liquid token investments for the firm.
Awesome. So over the past few years, I think we've heard a lot about this idea that digital assets, crypto in general, institutional players are going to come into the space, right? We've seen BNP Paribas, we've seen BNY Mellon, we've seen a number of other institutional firms come into the space, but I think there's always been questions of, is it real, right? And I guess the question is, where are the institutional investors and what role do they have to play in really creating a more institutional market in digital assets? And so, what is the role of the institutional investor in digital assets, and where are they really coming from?
Yeah, and I think that those are great examples, say, of institutions, say, creating or participating, say, on the custody side. But in addition, say, to custody players, we also see firms now engage in conversations around the use of digital ledger technology, right? And that's what's changed, right? When we first launched, say, Bitcoin futures, and that's back in December 2017, a lot of the conversations then were really around what is Bitcoin, what are cryptocurrencies. There was a lot of concern, say, about this new technology being used, say, for illicit purposes, but we're really seeing a shift away from that, where I think, now we're seeing institutions really embrace this technology. We've shifted away from concern, say, and speculative, say, interest in the space, to really now focusing on how do I use this, right? Yep. Looking at our space, we've been involved really since 2016 when we launched in conjunction, say, with CF Benchmarks, a leading, say, benchmark provider and regulated UK FCA entity, and introducing the Bitcoin reference rate, which really is the basis of our futures contracts, right? We saw this market transition from averaging about 100 million or so a day when we first launched, to now we're trading across both our Bitcoin and Ether products over $3 billion per day. We're also seeing, say, growth in open interest, right? And that growth in open interest is really a sign, say, of institutions in this space. Open interest this year is up about 14% compared to where we were last year. We're averaging across both Bitcoin and Ether about $2 billion in terms of OI. And then we also see the number of what are called, say, large open interest holders. And that's anybody that holds at least 25 contracts. So in the case of Bitcoin, you're looking at about a $3.25 million position. In the case of Ether, maybe about a $2 million position. But that number is averaging for Bitcoin about 115 such holders this year, up 20% from where we saw last year. So we're really seeing institutions adapt to this space and trading in our regulated markets.
Maybe Evgeny, I mean, from your perspective as an institutional player that's been in this space for 6 years plus now, how's that dynamic been changing, and have you seen the market continue to kind of progress towards broader institutionalization?
Yeah, I think it's been a huge change compared especially to 6 years ago, like when crypto was pretty much a dirty word in most of the TradFi. But now you see on one hand, yeah, we see BTC and ETH futures trading on CME, we see flood of Bitcoin applications from pretty much key asset managers on one hand. On the other hand, the technology itself is being very much accepted. Like you see PayPal launching stablecoins, for example. You see a lot of this being accepted as quite a possible alternative to basically existing financial infrastructure. And on our side as well, we see, whilst before we primarily traded OTC with crypto natives, with some maybe like opportunistic family offices, we see more and more counterparties which are like just traditional TradFi institutions, traditional TradFi family offices, funds, what's not. So it's definitely been a very clear shift in perception of crypto as something legitimate. And I think once now that we got Bitcoin and Ethereum in this like legitimate stage, I think the DeFi tokens and like a lot of other things can be next.
Yeah, I guess for Chris, talking about that institutional investment basis, what needs to be done for investor participation to really occur in the digital asset investment space?
Yes, so what we see right now is that there's a bit of a diversion between what we see kind of in the East and the West. And a lot of it has to do with the more hostile regulatory approach that's been taken in the United States. And then, of course, you have countries that are very aligned with the United States, and they're worried that some of those regulatory pressures could bleed into those other regions as well. So the large pools of institutional capital have been very cautious about approaching crypto thus far as it pertains to reputational risk, regulatory risk on their own. And so far, they get close, and then they kick the can down the road just a little bit further. To the point made earlier, on the family office side, the high net worth, where you might have a single benefactor or maybe a couple benefactors, the decision-making process is a bit easier. And if it doesn't work, you're not a public company, you don't have a ton of customers, it can be kind of hidden within a broader portfolio mix. But the risk of larger institutions making a misstep, in their opinion, is just too great still. So what we need to see is just a further development and further progress on the regulatory and even the political framework within the United States. As that eases, I think even allies to the US would start to ease back their own fears then that some of those views would be kind of incorporated into their own frameworks.
Yeah. I mean, maybe from a regulatory perspective, right, Prady, you're here in Singapore, right, and we just talked about this dynamic between the East and the West. What are the regulators here, and obviously places like Hong Kong and what we've seen with VARA and Dubai, what are they doing that's substantially potentially helping enable some of the energy that we're seeing here in Asia in terms of digital assets?
I mean, so from where we sit, we actually get the chance to look at it globally.
Right.
So we can actually see the so-called Western perspective and then the Eastern perspective. It's quite interesting. At least what we are seeing is a consistent theme across markets on retail consumer protection. Interestingly, though, I think because a lot of the action is in the US and a lot of people are actually looking to the US regulators to set clear direction, what is a very clear theme in this part of the world is that institutional participation is quietly supported. It's really up to each of the institutions what policies, how do they want to approach it. Definitely more progress as far as putting regulations in place. So you saw these stablecoin regulations come out of Singapore. You're seeing work happening out of the Middle East. You're seeing work happening out of Hong Kong, which is very positive for industry. So I think our focus, at least what we're seeing in this region, is more, hey, can you actually have clear regulations so that you don't leave these players unregulated? You have clear rules and guidelines, and you can function on that basis. Also, interestingly, I think it's got to do with the demographics. The focus is also a lot on non-institutional use cases like gaming and entertainment. I mean, a lot of people here would have been in Korea for Korea Blockchain Week and would have seen the sheer amount of activity and the focus in those areas, which really means that we see a very balanced approach in Asia, where clear rules, regulations, if not there, a clear marker as to when will you actually get these so that you can function accordingly. And of course, listen, everybody's looking to the US to say Europe now has MiCA, UK is putting regulations, and then we'll follow suit from there.
And just to add to that, like other positive developments, right? You know, we talked about, say, Singapore Mass, but Hong Kong has also made some announcements as well, where now that market is allowing, say, retail exchanges to now offer products, right? In Hong Kong, we also see Bitcoin-focused ETFs in market. And when you look, say, at our market and what the flows that we're seeing, say, out of the APAC region, about like 10%, say, for Bitcoin, about 12% of our Ether futures volume is coming out of region. Just this past Monday, we introduced a Bitcoin reference rate based on say, the Hong Kong settlement, or the Singapore-Hong Kong settlement. It publishes at 4 p.m. Singapore-Hong Kong time. And that's really an index, you know, providing, say, price discovery for any entities, for example, that are looking to price their portfolio or looking, say, to create additional ETFs or ETPs or OTC structures.
I guess maybe this is for Chris and Evgeny. You know, we've heard a lot around this idea of this Bitcoin ETF, right? BlackRock, right? Announcing they're looking into this, right? Is this a game changer for the broader industry in your mind? Does it move the needle a bunch? Is it overhyped? Is it insignificant? What does that really look like in your view?
I think it's definitely overhyped on one side. Like, to me, it's kind of inevitable. Like, it would happen sooner or later anyway. So
right.
I think like what people potentially getting wrong is just like the timing of it, because it will, even when SEC ultimately approves all the stuff, it will still take some time for those products to be launched, to be approved, to be listed. Then it will take some time for asset managers to actually do allocations to them. So we are looking at least 6 months before we will start seeing first inflows into those products. But probably, like, more realistically, I think it's like 1 to 2 years actually. But yeah, like I said, it's ultimately inevitable. So it was always like destined to happen, I guess. So from that perspective, yeah, it's quite hard to say how much of it is priced in yet. But yeah. I think once we will see real inflows, that's when the demo broke.
And it's a great development for the ecosystem, right? Because offering, say, a spot-based futures contract, or not futures, spot-based ETF, sorry, that is just going to open up the market to additional players who aren't there now. So it's not, say, that a spot ETF is say, it's not a winner-take-all, right? I think there'll still be, the futures-based ETFs will still be in market, and there's pros and cons, say, to both. But I think overall, the ecosystem just grows, and I think that's positive for the industry.
Yeah, I guess I'm a little bit more positive on you know, the benefits that having the spot ETF will bring in the near term. You know, just back to my earlier comment, a lot of the institutions that I speak to would see the approval of a spot ETF on Bitcoin and Ether as a huge regulatory milestone that they can check off their box.
Right.
And it's almost helping to legitimize crypto as an asset class, and a lot less as kind of this potential rogue investment vehicle. So a lot of the feedback I hear is positive. You know, I think on the other perspective, there is going to be a timing aspect from large institutions putting capital in. But, you know, let's be honest, I worked at BlackRock for over a decade. They are a great marketing machine. And one area of the market in the US that's been completely untapped is the wealth channel. Getting products approved on the wealth channel across many of these large banks has been very, very difficult. Now you finally have wealth managers that are going to have a very easy and accessible way for investors and interested parties to get exposure to crypto in a very cheap manner as well. So before you get the larger institutions getting through their CIOs and making allocations on a passive basis to spot, I think you could have a much faster reaction in the wealth channel to help bridge that gap to those longer term decision processes at bigger institutions.
But does that change the dynamic of the way that the market's been operating today, right? I mean, think about it. You have firms like yours, you have Wintermute, you have really large institutional crypto-focused players that have really been building out broader infrastructure to attract institutional investors. And then you have these large traditional institutional players that are coming into the market that in some way put a bit of a stamp on the market as a whole. Does it change the dynamic in terms of the approach that you guys will take to kind of broadly build out your business? Do you see it being more collaborative in a sense? What does that really look like for you guys?
From my perspective, I think it's going to help in the other parts of the business that we're working on.
Right.
We have a partnership with Invesco, so we're kind of hoping that spot ETFs continue to make progress. But outside of that, there's a whole other ecosystem that isn't going to be touched by those two digital assets. Mm-hmm. And as investors are getting more and more comfortable with understanding digital assets, think of them as kind of like your intro into a new asset, and then you start to get more curious. You start to look at other opportunities, and as you continue to see more technological innovations, and people are like, well, how can I get exposure to that? Where I think we need to be taking advantage of is making sure that we're helping them get access to those other areas of the market that just aren't going to be captured by some of those spot ETFs.
Prady, maybe I'll jump to you for a second, right? We're starting to see this dynamic of which products are being developed, right? We have these two camps, right? Maybe you call them, right? There's this kind of future forward camp in which there's DeFi, there's new protocols being developed, and then you have this other camp in which we're just trying to get to spot Bitcoin ETFs, right? Where do you think in the next, year or so, or what needs to happen for the institutional players to kind of move towards this secondary camp of looking at things like DeFi and these new protocols and enabling that in their portfolios?
So I would sort of take this conversation now beyond spots, ETFs and spot-based ETF or futures. I mean, if you just step back and look from an institutional lens, I think there's a common theory that in each crypto bull run, you're tapping a different pocket of wealth. So you started with the OGs, then you went to the folks who made the wealth from crypto, to the high net worth individuals, family offices, and then the prediction is that in the next wave, you automatically will have this massive tsunami of institutional participation. So I mean, if you just step back, at least our observation is that I used this analogy yesterday in another event where I spoke about how you've got DeFi, and it's truly digital native infrastructure which has benefited from being created de novo at a very different point of time. So since it's F1 season, I said it's like your Ferrari, right? So it's like, cutting edge, new infrastructure. But we're now beginning to talk about institutional participation, but a lot of the institutional participation is in the context of traditional infrastructure. And in that context, it's not just infrastructure, which is traditional, but also assets, which are more TradFi. And I was a bit brutal, but think of that as traditional road infrastructure, even cobbled infrastructure. So what really needs to happen here, at least in my view, is that you do need to see some bridging of these two worlds to say, okay, we've got this amazing infrastructure, and if you want broad-based institutional participation, then what can I actually use the infrastructure for? So, I mean, CME will know this very well. Galaxy's dabbling on both sides as well, is do I use it for risk management? Do I actually have other asset classes which can be deployed on this infrastructure? So I actually don't think that's a one-year time horizon. It does not coincide with any prediction of when the next crypto bull run comes. Right. This has got more to do with, can I first digitize all that infrastructure? Can I then put all those asset classes in some tokenized format? Can I have efficiency benefits? Can I have liquidity benefits, right? I think there's a lot more that needs to happen here, which will then allow broad-based institutional participation. And again, I'm separating this from, do institutions go and buy ETFs or go institutions buy and take some exposure to Bitcoin. I mean, we leave that to the firms to decide, right? I'm talking more longer term. It's a very long, painful journey of digitizing workflows, tokenizing asset classes, and then saying, can I cross-collateralize some of these assets, for example, right? And I think that infrastructure is being proven out in different contexts,
Right.
both on the TradFi and crypto, and that I think will drive much broader institutional participation.
And I think what's interesting, right, is that you're seeing, say, these large multinational publicly traded firms actively exploring, not just trading, but also exploring, say, how they can use, say, the underlying technology. And when you think of these companies are all, say, beholden to boards, they're beholden to shareholders. So they really have to do their homework and saying, like, we want to do this because, we see that underlying value, right? And that's something that they have to be able to convince, those boards and shareholders. So the fact that some of these firms are already like exploring in this space, they're doing so because they believe. They believe that this technology is here to stay. It's not going away. And digital currencies, as we've seen, say already with both Bitcoin and Ether, last year was a pivotal year. We saw the failures of some high-profile companies. We saw the failures, say, of some projects. But Bitcoin and Ether, they've been resilient, right? We saw those two coins rally earlier in the year. Volatility is back down now to historical norms. So you see institutions really taking this opportunity to build for that next generation, that next level of growth.
Maybe I'll ask a slightly challenging question. I was in Korea last week, right? And the question is, it's one thing for crypto as an asset class with those two tokens, right, that are not intertwined with the traditional system, right? They're not cleared centrally. There's no broader FMI infrastructure for it. Trades OTC. It's another thing to tokenize a set of asset classes today, like we've seen with ASX and others, that basically operate relatively efficiently, right? Payment channels are relatively efficient. Clearing and settlement cycles, while they're not immediate, right? They're trending down from T+2, T+1, getting down towards a real-time settlement. So is it real to think that tokenization will be a thing in other asset classes, or will it really just maintain itself in the crypto native sphere and not really translate across the board?
Yeah, so maybe I can have a first go at this. So I think you've already drawn the parallels, right? So you've got money movement, and then you've got what we would broadly define as capital markets or digital assets more broadly. On money movement, yes, they're efficient, but the efficiency is more on domestic payment infrastructure. So anybody sitting in this room can actually send money to each other on a real-time basis. Even if you're coming from outside the country, you can download a bunch of apps, wallets, you can do that. India's done that with UPI. There's a number of countries who've created the infrastructure to do real-time money movement. But that's not happening on a global basis.
Right.
It's just not happening on a global basis. So I'm not going to shield some of our efforts, but literally out of Singapore on a global basis, next quarter onwards, you're going to be able to do that for US dollars on a real-time basis, right? So I think that, so it's not so much tokenizing money as much as creating new digital payment infrastructure, which can then allow for real-time, 24/7 money movement. What it also does is it allows money to start becoming programmable. I mean, I use a simple example where you have a bunch of coders, say, and you literally can do a quality check and the code can be released. Why can't you write a bunch of code where money can move in an automated manner to a bunch of those coders, right? So if you think about broad-based micropayments, these are massive applications which are just not possible in today's payments infrastructure, right? So I think that's a concrete example that is quite distinct from crypto infrastructure, but it can interoperate with crypto infrastructure. So that's happening, by the way. This is not in the realm of this will happen 5 years later or 2 years later. There's a number of companies, including companies supported by us, which are actually doing this. And then the tougher one is actually on capital markets, because that has a whole value chain from an issuer to a custodian, the distributors, and you need to truly work with that value chain to see which intermediaries can I take out, and then how can I digitize some of that and yet deliver value. And that, to me at least, is unclear yet as to whether we've proven the benefit of tokenization. Does tokenization actually enhance liquidity? Equities is an obvious one. It's not going to solve the problem. I think there's been many failed attempts in that context, but there are OTC asset classes, there are funds, there are other asset classes where we think there'll be some benefits.
Maybe I'll speak to Chris and Evgeny. I mean, you guys operate in a space in which 24/7 markets, global liquidity, assets moving, basically jurisdictionless, right? You guys have built operating infrastructure, risk management infrastructure. Can the traditional folks actually execute all of these things to be able to define the value chain and move the market forward? Or what's the broader complexity that you see in the challenges that maybe they'll face that you guys have already looked at and think need to be thought about on the institutional side?
I could start, and I think Prady gave just a great, description of what's going on in tokenization. I think in kind of more developed regions in traditional finance, where you're not going to start looking for just an efficiency angle. You're probably going to start in the asset classes that are the most illiquid, because you don't take a liquid asset class and move it into an illiquid market space, which right now is the tokenization market space, because there's really not much of a market right now. But there's no harm in taking a very illiquid asset and tokenizing it, because you're not doing that at the expense of liquidity. And as we continue to build that out and build markets, I think what the traditional finance world will see is that there is a simplification process, there is an efficiency, there's a growing market, and it is providing that 24/7 capabilities. So it will take time. There are projections out there on how large the tokenization market will be, and it's probably going to be one of those technological adoption curves where it chugs along slowly, and then all of a sudden it starts gaining steam very, very quickly. That's what I think, and I think a lot of the traditional finance guys are going to wait until that point in time, until they have to make those changes. And then there's probably enough case studies of how people have done that along the way that they can do it in a much more efficient manner.
Yeah, look, I mean, I'm coming from TradFi background ultimately, because prior to creating Wintermute, I was pretty much traditional market maker for 10 years, and basically operating, especially on the cash side of things, trading ETFs, for example, dealing with T+2, T+3 settlements, going through the pain of sending cash overseas to create and redeem, for example. It is efficient, but it's like nowhere as efficient as it can be if you put a lot of it on a blockchain rails. Like starting pretty much with stablecoins, like it can be such a massive catalyst for improvement settlements, for example, on CME, ultimately, because it's like you can actually do instant settlement. You don't need to rely on banks. That's like very clearly, an improvement. And the second aspect for me is general democratization of how people can access certain opportunities. Like if I want to get access to, let's say, US Treasuries at the moment, I need to have an account in a bank. I need to transfer dollars there. I need to instruct them to buy treasuries for me. I need to rely on them to actually do it in a segregated way that it's still safe. I cannot. It's a lot of steps, a lot of which are quite inefficient ultimately, and tokenization of assets can allow, theoretically, for people to basically invest into those kind of like tokenized assets pretty much instantly.
I'll ask another question. Does the ethos change, though, right, with the institutionalization of assets or digital assets compared to where we are today, right? If you think about what we see, right, you see this idea that different layer ones, different protocols, right, they're built and they go direct to the retail consumer, right? There are opportunities for retail consumers to participate in the growth of a market, right? When you then look at institutionalization, that dynamic slightly changes. Do you see this friction being a large friction point for kind of the continued growth of digital assets, or do you think these two components or these two ideologies can kind of coincide with each other and together move the needle forward, I guess?
So, the way I think about it, right? I don't think that it's a winner take all. I don't think that DeFi, say, will take over, say, TradFi. I think both are going to coexist. for institutions to really adapt, say, to DeFi, I think more needs to be done, particularly on the regulatory front. I think those guardrails need to be there. There needs to be, say, more definition in terms of how these developers, how they should design these protocols so they actually work and can attract, say, that institutional participation.
Yeah, I mean, I'll just take a crypto native example of something as simple as just key management. When you look at how individuals manage the keys versus institutions manage the keys when they interact with crypto assets, it's different. I think that persona of that customer is just different. So I don't think you can simplify this and say that institutions will simply go truly crypto native in the direct-to-consumer formats, right? I think any institution will need a certain set of safeguards, processes. Counterparty credit risk matters, right? I mean, it's just a fact. I don't think we can wish it away. Yes, there are issues with the banking system, but there are also issues with stablecoin issuing systems, right? So, I mean, I think practically what's going to happen here is more that you keep building interesting new technology on the crypto side. It's very useful in the context of crypto native assets, but you take the components of those that can then be transported over to TradFi world, and we use the best of class technology from there, but we also learn and how to interact with it, still have KYC, AML, and you're able to create this new infrastructure. The one thing I'll say on a very pointed basis, and we can have the privilege of saying this, is that it's not going to come with a single dealer platform. So there's not going to be this one bank suddenly, which other financial institutions suddenly trust. So it will still come from completely new infrastructure that gets created by fintech companies or crypto native companies, which are eventually used by TradFi players. Now, it may be with the backing as equity investors or as customers, but it's going to be completely new infrastructure, which will be utilized, right? And it marries sort of both parts in a good way.
Yeah, I completely agree with that. And there's a lot of original crypto investors who are very much on this, decentralization is God path. But when you want to really scale a technology, you need safeguards in place for users. My view is that for crypto to really explode mainstream, you're going to have to introduce more centralization, let's call it at the app level, as opposed to the decentralized blockchain level. And what that does is that helps build trust with users that someone's got their back if something goes wrong, as opposed to a fully decentralized system where they're just worried that nobody's there to help them out. My view over the next 5 to 10 years is we're going to see more and more companies, corporations entering into crypto, and they're going to be sitting on top of decentralized blockchains, but they're going to have kind of that protective wrapper around the service, the product that they're offering, that helps to really give that insurance clause to users and larger institutions that it's safe to use it and we've got your back.
Yeah, to me it's more like I don't necessarily see it as a massive conflict or erosion of values. Like I fully agree it can be a massive catalyst for innovation in general and for increasing the user adoption, increasing the usability of these new technologies. To me, what's important is we continue to have a choice, and that whatever regulation comes in all the countries, they don't push everything to be in one centralized place, basically. It's like if I do like a very, very basic analogy, like I currently can store money in a bank, but I can also take this cash and put it on the mattress. Like it's not going to be as productive, but I have this option at the moment.
Right.
With CBDCs, I might not have this option. And to me, what's important with crypto assets going forward is, yeah, if I don't want to bother with storing my private keys, yeah, I go and put them as a centralized entity, and then I will be quite happy with it, I guess, and quite like not concerned with doing anything wrong on my side. But it's important for me to have a choice to actually store it in non-custodial way, self-custody way, and basically to be able to control it myself and not having to go through KYC email for this, to be honest. Yeah.
I guess from your view, I mean, which regulator is finding that balance, right? Because I think you have, in Indonesia, you have this idea of a centralized depository, so almost like a CSD infrastructure that's being pushed. You have obviously stuff that's happening with VAR in Dubai, you have MAS. Right now, which regulator do you guys find it has that right balance of enabling innovation and enabling that choice to occur, and why is that the case?
Yeah, good question. I don't know. There are not so many that come to mind that are like truly crypto friendly. Maybe Swiss authorities are pretty good actually from that perspective. Like, I think this KYC ML aspect is a main pain point for regulators to come to grasp with this new technology, because they don't necessarily want to give it away. Yeah.
But I think it would be interesting, right? When you think of regulators, around the globe, I think they all have similar interests, right?
Right.
It's all about protecting, individuals and ensure that there's safety in there, right? So it's almost like we need, say, regulators to just get together and work together, right? And instead of having, say, nationalistic, say, regulation, let's have something that's more universal, right?
Yeah, I think too, emerging markets have a bit of a benefit here in that they don't have incumbent companies which already have the infrastructure in place. And the big opportunity would be creating a framework in place in some of those regions quickly, but thoughtfully, to really encourage development with this new technology. In developed countries, there have been some that have been more forward-thinking, but there's also a bit of needing to protect a lot of the investment that took place for decades before.
Right.
And it's a lot harder to kind of steer a new technology straight into the middle of that and split it wide open. So that's why I think we've been much slower in the US, but it is inevitable at some point. It's just going to take a while to get there.
So we have 2 minutes left, and maybe I'll ask this question, the final question. It's, we see a lot of POCs, we hear a lot of announcements. In my opinion, it's great experimentation, but it's nothing that's yet driving everything forward. I guess from each of you, what are you guys looking for in terms of your predictions for the overall trajectory of the digital asset markets as we see it from an institutional perspective? And really, are there specific milestones or aspects that you would look at and say, when I see this, I think we're on the precipice of actually really moving towards a full-scale adoption of digital assets as a whole?
For me, it's having both Bitcoin and Ether spot ETFs in the United States. I think that would be a huge hurdle to overcome, and I feel pretty confident that that's really going to help open up institutional investor eyes to a broader crypto ecosystem and what the opportunity is.
Evgeny?
To me, I would say I mostly look at retail, I guess, and that would be making sure that onboarding into crypto is safe and secure, and you don't have all this horror stories with Bored Apes, for example. It's basically abstracting away this onboarding process as much as possible and make it safe.
Yeah, so we've already commented on the crypto native products. So what I'd say is the marker to watch, and I said, is money movement first. So you have stablecoins, already has product market fit in the crypto context.
Right.
How do you take fiat and provide similar functionality? To me, I would watch that as a marker. I think once you get those rails in place, then digital assets more broadly defined will be coming next.
Awesome.
And I look at more, say, the regulatory clarity, right? And moving away, say, from sort of like a post and accusatory regulation to really developing those guardrails. And also prime brokerage, I think in the space is something that's needed in the space, and hopefully that's something that's coming shortly.
Awesome. Giovanni, Prady, Evgeny, Chris, thank you again for your time today. Thank you for spending time with us to really talk around the institutionalization of digital assets. Hopefully, a lot of the products that we're seeing here will be key pillars to the movement of this space moving forward. So thank you again very much for joining us today.